Simon Maughan is Head of Sales and Distribution at MF Global, and he joins us now. Thank you so much for joining us, Simon, today. Does this mean that actually we can look to a rosier picture for a lot of these Swiss banks?
No, it doesn't. UBS has a tactical mission every quarter to report a profit. They see the losses of previous quarters as instrumental to the outflows from the private banking business, and therefore they will do anything to ensure that there's a profit. Obviously in Q3 it's extremely difficult to engineer that because of the sizable loss that they've taken, over 2 billion Swiss francs from trading. But they're very, very fortunate in that the value of their own debt has fallen, largely because of this incident. But actually, under accounting terms, that allows them to book a gain on that debt rather perversely, which almost offsets the trading loss. So actually, that creeps them back in towards what they're calling a modest profit.
And so, Simon, talk me through the banks that are actually the most exposed to risk.
Well, obviously, we've seen the moves in France and Belgium around Dexia. Those shares off sharply today. Dexia has a significant balance sheet, nearly 600 billion of euros at last count. It's nearly 200 billion of which is in government debt, largely Belgium and France. And there lies a key and critical point. Because since the crisis, one of the things that regulators have done is basically say to the banks, you must hold more liquid, risk-free assets, which basically means government debt. And so the banks have been forced to buy more and more of it. Collectively, they've bought trillions of euros of this stuff. Fast forward 3 years, we found out this debt isn't risk-free. It's actually going to cause a problem. So basically, the larger the bank, the more of this stuff you've been forced to buy by regulators in the last few years.
And so in terms of country by country, I mean, you're very concerned, of course, about French banks, Dexia, possibly being recapitalized by the French government together with the Belgian government. But Italian banks are also a concern.
Yes, I mean, clearly the epicenter of the crisis is continental Europe, and the banks in the UK, the Nordic region, Switzerland look relatively immune, but only relatively. Because of their free flows in currencies or the better economic underlying situation. Clearly the epicenter of the problem is in continental Europe. But France is coming in for particularly singular attention, because the bonds in countries like Spain and Italy have already blown out. We've already seen moves and ECB interventions. There is a large gap between the yields on Italian and Spanish debt and that on French. But if the Eurozone politicians continue to ignore the problems at the heart of the Eurozone and fail to come up with solutions, we know that France is going to get worse, and that's why French banks and French bonds are coming under attack. That's where the money is to be made from asset prices falling.
That's where the money is to be made, Simon, because you believe that at the end of the day, although investors are concerned and they're attacking a lot of the banks will survive either through some kind of recapitalization of the government or just because they're strong enough and their balance sheets are strong enough to withhold this.
Well, whether it's recapitalizing Greece and then maybe Portugal and potentially other economies, or whether it's recapitalizing the banks, one of those two options has to be taken, and that, of course, will include providing an awful lot more capital to the European Central Bank. We know that France and Germany are going to have to shoulder the lion's share of that bill, and clearly when they come to do that, that's going to put pressure on state funding, government finances, which will push up bond yields. And what I mean is that bond yields are still relatively low in France, although they have been rising relative to what you see in Spain, relative to what you see in Italy. Therefore, if there is to be question marks over, the structural positioning and the French fiscal deficit, then those bonds will rise in yield, fall in price, and that's what I mean where the money is to be made, by getting hold of that price action.
All right, thank you so much, Simon. Simon Maughan there from MF Global.